One of the things that I love about investing in the stock market in 2024 is it feels like every other day now there's a new investment vehicle that comes about that pretty much solves every single problem, more or less for every single investor out there, regardless of exactly what you're looking for. Now in this video specifically, we're going to go over this newer ETF that I just came across as of recently, ticker symbol BOXX, or the Alpha Architect 1 to 3 month BOXX ETF. This ETF could be extremely useful, especially for investors that want to earn a ton of returns in a very tax efficient manner. Now I promise you I would not waste your time. This ETF is definitely worth looking into, so stick around, drop a like down below, and let's get right into this one. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So like I was saying, just as of recently, I came across this ETF. I'm talking about the Alpha Architect 1 to 3 month BOXX ETF. And although after digging into this ETF a little bit deeper, the strategy is a little bit confusing, but I think this ETF could be extremely useful for those investors out there that are looking for a tax efficient manner and want to earn more or less guaranteed returns long term. Now, this ETF uses a strategy called a box spread, or a long box spread. Listen in.
A long box spread is an option strategy that aims to create a cash alternative. What are the legs of a box spread? A box spread utilizes 4 positions implemented simultaneously as one trade. The first 2 positions recreate a synthetic long forward position by buying a call and selling a put at the same strike and expiration. The second 2 positions recreate a synthetic short position by buying a put and selling a call at the same strike and expiration. By creating both the synthetic long and short positions at the same time, 3 things happen. First, all market risk is eliminated. The underlying asset price can move up or down, slowly or suddenly, and the box position will be fully hedged.
So this long box position is basically an option strategy which more or less hedges the play from every single angle, no matter what happens during that time frame. Now this strategy is tax efficient because, as you're going to see here in a second, it doesn't pay out anything, it doesn't pay dividends, it doesn't pay interest, it basically reinvests it more or less into the fund. But just hold on, we're going to go over that more in a second. Now next is his treasury bill risk. The strategy seeks to have a similar risk profile as treasury bills, which, as you and I know, treasury bills are more or less very, very safe, unless of course something massive happens with the government. Now here's the most important part. This is what really got my attention when it comes to this ETF and what I found very interesting. Treasury bill returns. The strategy seeks to earn returns similar to that or better than treasury bills, but again without actually paying out anything, meaning that it's going to be very tax efficient and you're only going to get taxed when you actually sell. Now with the normal sort of treasury bond ETF, something like ticker symbol SCHD, the iShares 0 to 3 month treasury bond, if rates stay relatively the same, this ETF for the most part trades exactly sideways and pays out more or less depending on when the dividends are going to get paid every single month. And as of right now, something like SCHD, because it invests in treasury bonds, is paying a trailing 12-month dividend yield of around 5.21%, which is more or less, of course, where treasury bonds are paying. So you might be still asking, what's so interesting about BOXX and why is it different than something like SCHD? Well, like I said, over the last year, for example, SCHD pays out on a monthly basis, and again, the fund basically trades either higher or lower to a discount depending on when you invest into it relative to the time of the most recent payouts. Now, the reason this ETF is interesting, once again, is that ticker symbol BOXX does not pay a dividend, but instead, through investing into treasuries or indirectly invest into treasuries, the ETF BOXX is going to, instead of paying out a dividend, instead of paying out an interest payment, is going to give investors price return, which of course is not going to be taxable until the investor would sell off the ETF. Now I came across this article talking a little bit more about BOXX, and they talked about some of the pros and cons of this ETF. Let's go through it. They said the primary benefit is clearly the tax efficiency, which is once again, for the third time, why I find this ETF so interesting. You're basically invested into treasuries, but instead of getting taxed on the payouts, you're not going to get taxed unless of course you sell. The tax efficiency the fund brings to the table while replicating T-bills. This feature can result in significant tax savings, particularly for investors in higher tax brackets. So this, of course, like any other investor, is not going to be perfect for every single investor out there. But again, I just absolutely love all these different investment vehicles, all these different assets that are coming about in the markets over the last few years. Additionally, BOXX provides cash-like returns with minimal risk, making it an attractive alternative to traditional money market funds and short-term bond ETFs. To me, the big problem here, though, is it's all too complicated. And even after I watched the video on the BOXX website, I still hardly understand what a long box spread is. The strategy is pretty complicated. And this is because the investment strategy is based almost entirely on the use of options. Second, the fund does not distribute any regular income, making it less attractive to income-focused investors like myself. And third, while BOXX has done well since inception, the fund has only been around for a short time frame. The option strategy is working, but do we know how long it's going to work over the long term? Do we know if it's going to work during every single market condition? Of course not. So although this new ETF that basically pays out T-bills, but instead of paying out in dividends, pays it out in price return, which could be extremely useful for certain investors, I still think this could be an amazing opportunity for certain investors out there that are looking for something along these lines. Especially for some investors that have some cash on the side that don't really know what to do with the cash as of right now, but want to use their cash and put it somewhere where it's going to be possibly much more tax efficient. But lastly, most importantly, now I want to hear from you guys down below when it comes to this new Alpha Architect 1 to 3 month BOXX ETF. Is this something that you personally would invest into? Let me know in the comments, yes or no. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.